Hello everyone, welcome to weekly lecture videos. Our this week's topic is Introduction to Fintech and Fintech Risk. You perhaps can recall that we started discussing Introduction to Fintech last week. We essentially learned about what is Fintech, Fintech evolution, Fintech ecosystem, and applications of Fintechs. So we continue to discuss application of fintech this week, and additionally, we will learn about fintech risk and fintech regulation in Australia. So we have three main learning objectives today. We will continue to discuss fintech applications, and we will learn about fintech risk and opportunities, and also fintech regulations in Australia. So as I already mentioned that we started discussing fintech applications last week, we will discuss few additional applications of fintech in today's world, like algorithmic trading, Internet of Things, biometrics, and big data. So I will mostly be talking about these 4 points in this video, and in the two subsequent videos, I will be discussing fintech risk and opportunities and also fintech regulations. So first of all is algorithmic trading. Algorithmic trading is the computerized buying and selling of financial instruments. And this buying and selling takes place on the basis of pre-specified rules and guidelines. Algorithmic trading is often used to execute large institutional orders, slicing orders into smaller pieces, and executing across different exchanges and trading venues. Algorithmic trading provides investors several benefits. For example, speed of execution, anonymity, and lower transaction costs. Over the course of a day, algorithms that is used to buy and sell financial instruments may continuously be updated and revised to make new execution strategy based on changing prices, volumes, and market volatility. Algorithms may also determine the best way to price the order, for example, limit order or market order, and the most appropriate trading venue, for example, exchange or dark pool, to route for execution. High frequency trading. High frequency trading is a particular form of algorithmic trading that makes use of vast quantities of data to automatically place orders when certain conditions are met. Trades are executed on an ultra high speed, low latency network in a fractions of seconds. High frequency trading algorithms decide what to buy or sell, where to execute based on real-time prices and market conditions, seeking to earn a profit from intraday market mispricing. While high frequency trading sector was once highly lucrative, it became increasingly difficult to compete on the speed of execution only. As deals get executed in billions of a second, the cost of staying on the top of technology has reduced profit margin. The high frequency trading rush unleashed franchised investment in wireless capacity, efficient computer switches, and coding talent. Rather than outpace each other with competing paths, top companies in the space form a consortium to build a single route, sharing bandwidth and costs. The consolidation wave could result in only a few large players that are able to invest in the best technology and a bottom tier of niche specialists, making mid-sized firms uncompetitive. So you can see that high frequency trading were once seen as profit generating machines, but now it seems competition has changed. And this shift has partly been caused by competitive pressure and partly by the fact that market is reflexive. And in this case, reflexivity refers to the phenomena of market participants losing their competitive advantage because of their presence and actions in the market change and change in market behaviors as other participants adjust to that. So it is likely that financial technology will diffuse through the market as incumbent financial institutions adopt, and fintech firms will face the difficulties high frequency tradings are experiencing. The next one we are going to talk about is Internet of Things. Internet of Things is made up of connected devices from simple sensors to smartphones and wearables. Wearable devices have arguably been the easiest win for banks so far, thanks to a growing ecosystem of devices and the relatively low cost associated with getting started. Many banks now provide applications for popular wearables like Apple Watch, Fitbit, which is already working with the Bank of America. Some banks have even launched their own devices, for example, BPay by Barclays, and also some more wearable bands are coming. For example, Payware by the Australia's Westpac Bank, and also CXA Bank and Hellenic Bank are bringing more wearable bands for contactless payment solutions. Next one is biometrics. Biometrics identifies individuals through unique physical characteristics such as facial recognition, fingerprint, iris verification, as well as behavioral patterns such as voice identification. Biometric authentication gives financial institutions independence from passwords, PINs, and tokens, which are susceptible to attack and can offer significant opportunities ranging from security to mobile payment solutions. However, biometrics is not foolproof. Biometrics are also subject to cyber attack, and ramifications of any security breach involving biometric information is likely to be much more serious than a security breach involving a password or a PIN. The last one that we are going to discuss under the fintech application is big data. Well, big data is not a technology itself, but big data is used by many of the fintech applications we have discussed the last week as well as this week. So data sets that are in use are growing rapidly in terms of the size and diversity of data types that are available for analysis by different stakeholders. Big data includes data generated from traditional sources, for example, stock exchange, companies, governments, as well as non-traditional sources, for example, use of electronic devices, social media, sensor networks, so on. Traditional data sources include corporate data in the form of annual reports, regulatory filings, sales, earning figures, conference calls with analysts. Traditional data also include data that are generated in the financial market, including trade prices and volumes. Because the world has become increasingly connected, we can now obtain data from a wide range of devices, including smartphones, cameras, microphones, radio frequency identification readers, wireless sensor, satellites that are now in use all over the world. As the internet and the presence of such network devices have grown, the use of these non-traditional data sources and alternative data sources, including social media, email, text communication, web traffic, online news sites, and other electronic information sources has risen seriously. The big data typically have these three characteristics: volume, velocity, and variety. Volume refers to the amount of data collected in files, records, and tables in very large, representing many millions or billions of data points. Velocity, on the other hand, is the speed with which the data are communicated. Real-time or non-real-time data have become a norm in many areas. And variety is the data that are collected from many different sources that we just discussed a few moments ago in a variety of form, including structured data, semi-structured data, and unstructured data. So if we look at this diagram, we can see that the volumes of data are, you can see that growing from megabytes to gigabytes and even terabytes. And at the same time, data also have more traditional and non-traditional available on a real-time or near real-time basis. So you can see that previously data used to be available in batch, periodic, for example, yearly, semi-annually, monthly, or weekly. And now data are available near real time, for example, say every minute data, and even real time, for example, the data that is being generated in every moment. Okay. Data also are available in the form of structured, semi-structured, or unstructured data. So structured data items can be organized in tables, are commonly used in a database where each field represents same type of information. Unstructured data may be disparate, unorganized, and that cannot be represented in tabular form. So unstructured data usually generated by social media, email, text messages, video recording, pictures, scanners, sensors, and so on. Okay, so in order to analyze data that contained in emails and text, especially developed a customized computer code may be required to first process these files. Semi-structured data, on the other hand, may have attributes of both structured and unstructured data. And sources of big data. Big data can be generated by financial markets, businesses, governments, sensors, and the Internet of Things. So let me give you a few examples. Financial markets, for example, equity, fixed income, futures, options, and other derivatives. Businesses also generate big data, for example, corporate financials, commercial transactions, credit card purchases. Governments and individuals, for government, for example, trade, economic, employment, and payroll data. Individuals, for example, credit card purchases, product reviews, internet search logs, social media posts. So those are the data generated by individuals. Sensors, for example, satellite imagery, shipping cargo information, traffic patterns, and in particular, the Internet of Things, for example, data generated by smart devices, let's say a smart building. So data in relation to climate control, energy consumption, and other operational details generated by a smart device will also be a source of big data. In gathering business intelligence, historically, analysts have tended to draw on traditional data sources, employing statistical methods to measure performance, predict future growth, and analyze sector and market trends. In contrast, the analysis of big data incorporates the use of alternative data sources. So what are the alternative data sources? And once again, alternative data sources are individuals, business processes, and sensors. So I already gave you examples of that. So data generated by individuals are often like text, videos, photos, audio formats, and may also be generated through such as website clicks, time spent on a web page. So this type of data tends to be unstructured, and the volume of this type of data is growing dramatically as people participate in greater numbers and more frequently in online activities such as social media. Business processes data include information flows from corporations and other public entities. These data tend to be structured data and include direct sales information, credit card data. A business processes data can be leading or real-time indicators of business performance, whereas traditional corporate metrics may be reported only on a quarterly or even yearly basis. Sensor data are collected from such devices as smartphones, cameras, satellites that are usually connected to computers via wireless networks. So sensor data can be unstructured, and the volume of data is many orders of magnitude greater than that of individual or business processes data stream. This form of data is growing exponentially because microprocessors and networking technology are increasingly present in a wide era of personal and commercial electronic devices. And big data are used by artificial intelligence and machine learning that we discussed last week to make various individual and business decisions. So this is the end of our discussion with regard to fintech applications. So in the next videos, I will be talking about fintech risk as well as the fintech regulation in Australia. Thank you very much.